As we delve into our outlook for 2023 in the global equity markets, we realize it may be counterintuitive to have a dismal outlook for the first half of this year from an economic standpoint, but still see a lot of opportunity in equities for the second half of this year as well as 2024. First of all, that's because we think the bulk of the damage has been done. This is not the time to sell equities. When you look at this chart, it's showing you that the bear market that we saw in 2022 is basically at or near the historical average that you see as far as the magnitude of bear markets. So the wrong approach would be selling equities at this time. The right approach would be looking at from a contrarian perspective. The area of the equity market in the U.S. that we like is the small and mid-cap space. We still think large cap has some room for some valuation discovery to fully reflect what we see as far as the interest rate environment going forward. And when you look at these tables, it shows you just looking at from a valuation perspective where current valuations are compared to history, and it's showing you that large cap equities, either growth or value, they're expensively priced versus their historical averages. But when you look at small and mid-cap stocks, look at those. They're historically cheap compared to their historical average. So from a valuation perspective, check the box. Small and mid-cap stocks are more attractive than large cap stocks. And then when you look at how small cap stocks tend to perform leading out of a recession, look at this chart. It shows you that small cap stocks outperform in the 6 months, 12 months, and even 2 years by a significant amount their large cap counterpart after a recession. So in the US, stick with the small and mid cap space. The developed international market, that's a big contrarian play that we like a lot going into 2023. International equities have been underloved, and what we've seen is from a valuation perspective, you can see that they're historically attractive compared to the U.S. So valuations, a supporting factor for international equities. Also, when you look at this next chart, it's showing you that on a rolling 5-year basis, the S&P 500 has outperformed the MSCI EFA, which is your developed international equity market, by a significant amount. Well, that red line, take a look at when that started. That started after the Great Recession, when we came into this decade of ultra-easy monetary policy, which resulted in inflated valuations in select areas of the U.S. equity market that necessarily weren't as concentrated in the international equity market. This is something that we think is going to change in 2023 and beyond, and we've already started to see that occur. Also, from a quality and constructive contrarian perspective, PE multiples, they're not going to expand the way that we've seen because the interest rate environment is changing. So more of the total return for equity investors will be from dividends and from earnings. And what you can see when you look across the globe in this table, that not only from a dividend yield to international equities have much more superior yields than the US, but their dividend growth rates, the expectations for next year are very attractive, and their dividend payout ratios, or what they're paying to their investors, are higher than a lot of areas in the US. So we continue to believe that the international equity market is the best place to be in the global equity market for this year.